Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, look at some information on there. I know the markets are closed. It's President's Day. Kind of be a pretty boring day. I like it when the markets are open. But we'll go through commodities, stocks, a bunch of different information, and I'll throw on my financial opinions as I go and my experiences. If you want to follow me, it's at finding_finance, and we're going to get right into it. So I've got Peter Lynch here. Peter Lynch, I like his quotes. I think he was a really good investor. He wrote the book One Up on Wall Street. A lot of quotes from there as well. And he basically had a return of 29.2% on average. The average doesn't mean he achieved that every year. It means that some years were very, very good. Other years were not as good. But the average was 29.2. And this is coming from him. It is a thread, and I want to read some of his quotes because he's such a good investor that we should adopt a lot of the things that he has done over the years. It says, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than have been lost in corrections themselves. Focus on what you know and can control. And I'm saying this in the oil markets because the oil markets are dirt cheap. You can buy oil companies for, a couple times cash flow. And usually when you get to that type of setup, good things happen. Now, could there be a correction? Could there be a recession? Could there be all that stuff? Yeah, it very well could be. But I think the companies from a risk standpoint are pretty low. And given where they're trading, they're of really good value. And even if they were to get cheaper, the way that I would handle this is that I would buy more in the future if they were to get even cheaper than where they are today. That's my philosophy, my paradigm, the way I look at all these things. But it's also the paradigm of his. Commodity stocks are a little bit different than regular stocks, as regular stocks get to control the selling price of their products. Commodity companies do not. But we do know that oil and a lot of other commodities are heavily underinvested. And if we get a recession and they go down, they won't stay down like they did after 2009. It's a completely different market condition, which means that they are so underinvested that, and the capex did not flow into it, that there's going to be shortages no matter what in the future at some point. And it's going to be probably in the immediate future. I've seen projections of oil somewhere around, I don't know if this is right, 110 million barrels by 2025. I don't even know if the world can produce 110 million barrels. So we'll see. We'll see if the world can do that, but we're going to get in a really tight scenario in oil, I think. And a lot of people are trying to anticipate the correction. And I think that we're just early in that. I think we're a little early. I don't think it's going to be immediate. I think it's going to be out a little ways. We are still raising interest rates. And when you're raising interest rates, generally you're not at a problem area. The Fed doesn't think so. That's why they're raising the interest rates. But maybe out 6 months to a year, that could be a possibility, or maybe 3 months. Hard to say exactly when, but I still think there's some room to run. It says, know what you own and know why you own it. Never borrow conviction from others. Do your own research and build your own assumptions. So know what you own. Why do you own the companies that you own? You should know every single company in your portfolio. And you should know why you own it. A lot of the companies I own, I found them based off of the technical chart patterns. And there's some that I own that are more dividend paying type companies, like a big diversified mining company that pays a large dividend. There's reasons why I own different companies. There's ones that I may be speculating on in uranium because I think the upside is so great. Companies with zero debt, your risk is that they will dilute you to raise money. That's where your risk would be. But know what you own and know why you own it. An important key to investing is to remember that stocks are not lottery tickets. Think of stocks as businesses, not tickers on a screen. The way that I view this It's not necessarily about owning a business per se. It's about owning a piece of the way that I view it is I look at a sector and I look out in the future and I say, man, we could get really tight on drilling. So then I'm like, well, I want to be a part of drilling companies because of this, this market condition that I think is coming where oil is going to get very expensive, everyone's going to go to drill, and then we're going to get tight in the drilling sector. So yes, I do think of it as a business, but I also think of it as I want to be part of that. I want to have some investment in drilling companies because of what I see in the future and the market tightness in drilling companies. It's not, I don't look at it as a lottery ticket. I don't look at it as just a ticker. I look at it as I want to be a part of this oil bull market. I want to store my wealth in oil in the ground that they have 30 years of reserves with. I want to be a part of this company because of the oil and natural gas that it holds as reserves and the untapped drilling locations that this company has, which could be vast. And I'm paying very little market cap for it. Like, that is how I view things. If a company is making something that's unique and it's going to be used in the future more so, let's say it's an energy service company or something like that, I want to be a part of it. Like, I want to be a part of that company because of that ride. It says, just because you buy a stock and it goes up does not mean you are right. Just because you buy a stock and it goes down does not mean you are wrong. In the short term, markets are voting machines. And this here is what everyone does in the comment section, on Twitter, on all of this crap. I call it crap, guys. Just because you buy a stock and it goes up or down does not mean you are right. So people say, oh, I think that natural gas is going to go up or down. Notice I look at charts and I try to make predictions based off of charts. Not really predictions. I just say, look, the probability is higher or the probability is lower. I don't really try to make predictions. I do talk about, if oil were to get to some gold to oil ratio like it did previous markets, this is what the price would be. But I never say this is what the price will be. And I don't put a time frame on it. I just ride the trends. I say, look, the trend is broken to the downside. The downtrend's broken. We're moving higher. I'm going to get in, and these companies are cheap. Or the company's in a really good location from a technical standpoint, and the sector is turning. Now, I know a lot of people, what they do is they'll say, oh, you're right. Oh, you're wrong. You got this one right. You got this one wrong. You said oil is going higher. Guys, oil is going higher because I have a long-term view that we have a market that doesn't have the investment in it and a demand where I don't think supply can reach. Now, does that mean in the short term that oil, can go lower? Yeah, it can go lower. It definitely can. But my viewpoint is if oil goes lower, I want to buy more of those reserves in the ground because I think that we are going to hit problems out in the future within 10 years. Definitely within 10 years, maybe even 5 years, maybe 2 years. We are very close, and I don't know the exact timing of it. Now, could there be a recession or a drawdown in the short term? There very well could be. But that doesn't prevent me from wanting to store my wealth in oil in the ground with these companies. It's that simple. And it takes time for that outlook to materialize. So it's not that I'm wrong because I'm taking a 5 to 10 year view on it. It doesn't mean that the price going down means I'm wrong or right. And sometimes things move very quickly. I bought the bottom in oil and I made a bunch of money. And it doesn't matter even if you're wrong in the short term, even on a sector if you're wrong. And even if you lose money in the short term, if there's volatility, doesn't mean you're wrong. You can be wrong in one sector for a period of time and make so much money in your other sectors that you're just laughing at the people that are telling you that you're wrong. You're not going to get every call right if you are trying to make calls. You're not going to get every company right. It just doesn't happen in investing. What you're going to do is if you get a couple of 30 baggers, you just start laughing. $10,000, $20,000 turns into $600,000 on a single position. That's what winning feels like. Now, someone's going to say, oh, well, you didn't get everything right. You're not going to. You're not going to get everything right. You're not going to get every call right. You're not going to get every stock right. That's just the way it is. That's investing. That is part of the game, and you have to adapt to what the game is. You have to accept that. But as you get better and better, there's going to be times in your life where there's these setups. And these setups are so lopsided in terms of risk reward that you have to pile in big to it. I'm not saying that we have to set up this very second. And you're going to know if you're part of the channel on the website, and maybe I'll talk more about it. And I talked about it last Platinum question and answer session. I said there's going to be times where if you hang around me long enough, you're going to know when to go big. When people get afraid, and recessions are not bad. You know why? Because if something goes down and you have the fundamentals on the long term remain intact, that is how you make big money. You need to take an outlook that's longer, where you've got a positive structural underpinnings of the market, but they're structurally strong. There's underinvestment, and maybe there's going to be a reflation trade or something like that. You look out, and then in the near term, the markets in the near term are fearful, and they shoot everything to the downside. But you see, through ratios, through market conditions, through the structural underinvestment, I mean, the best thing that can happen to all of us as investors right now is that we actually get a recession. Everybody gets fearful, pushes everything to the downside dramatically, and we load up in some of these underinvested commodities. And then a year or two later, you're just going to be laughing. That is like the ideal thing that you can think of. The ideal thing, and I'm not trying to say that this is ideal from a humanity ethics standpoint. I'm just saying there's probably going to be a scenario where natural gas gets really cheap, like it is. It swings all the way back down, and then it's going to swing in the opposite direction massively, providing what I could say as the largest buying opportunity of any stock, of any sector, of any time in history, where that could be the potential for that to happen. We're cheap right now, but what if it got cheaper? What if we got down to $1.50 or something like that? These companies' risks in terms of their debt, and they've been repaying their debts off. What if their risk isn't as bad as it was in 2020, but they sold off? And then it swings where we get cold weather next winter, and it draws down inventories in Europe, and prices shoot up to some ridiculous level. That is a high possibility of happening. I mean, a very high possibility. And that's probably what we should be looking for. So keep this quote in mind. Just because you buy a stock and it goes up does not mean you're right. And just because you buy one and it goes down does not mean you are wrong. Remember that. That's a big one. And I made a lot of money on this because the short-term volatility brings you down. And I'm looking at the longer term saying this is going to come. The fundamentals support much higher prices than what the short term is pricing. It says there's always something to worry about. Avoid weekend thinking and ignoring the latest dire predictions of the newscasters. Sell a stock because the company's fundamentals deteriorate, not because the sky is falling. So it's signal over noise. That's just market noise. Do not worry about the dire predictions of the newscasters. All these guys coming out. I mean, I can tell you, Harry Dent, that guy is super negative. There's a lot of super negative people on Twitter, on YouTube, maybe because YouTube and the views have you've got the feedback loop that tells them to release more doom because people are more willing to hit it. You know, they're more willing to click on their doom predictions and stuff. The people who make money, we're more or less optimistic over time. We're not doom and gloomers. If you look over long periods of time, and if you have a long enough time frame, and you're not trying to time these market pullbacks, you can just keep buying into it as long as the fundamentals are good. Like, that is the outlook you must have if you want to make tons of money. And at least from an investing standpoint, that the Buffett and Peter Lynch approaches. Obviously, there's hedge fund managers that have done well trying to time some of this short-term stuff. I fall much more in line with these guys and Buffett than I do with some of the other investors. And I understand that commodities are cyclical, but the commodities time is coming. It says if you if you have to let the big ones make up for your mistakes, in this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. You don't need to be right on every investment, but maintain a solid average. There you go. And I completely agree with it. There's times where you just don't get it right. You pick the wrong company. Maybe you buy a Russian company and they take that investment from you, or something happens with sanctions. Stuff happens. But that's why you diversify. That's why you limit your portfolio exposure to a single stock at a certain percent, whatever percent that is. That's why we have strategies. And that's why we do high rewards in relationship to the risk. Those asymmetric bets is what's going to pull your entire portfolio up. It says some stocks go up 20, 30% and they get rid of it and they hold on to the dogs. And it's sort of like watering the weeds and cutting out the flowers. You want to let the winners run. This is something that I also talk about on the website quite a bit. It says, let your winners pay for your losers. Don't sell your winners to double down on losers. The way that I view it sometimes is if something's working, pile into it. Keep piling into the stuff that works. Get rid of the stuff that isn't working. I started doing that about 10 years ago, maybe. Yeah, about 10 years ago. And I got addicted to just piling into stuff and averaging up. I know that sounds weird, but I pile into things that work. And then I continue to pile into the things that work for a period of time. For things that don't work, I really start cutting it. I even may trim the entire position altogether, depending on if the fundamentals of that company have changed or if they did something that I don't like. What are some examples? Well, I don't like when I buy a small cap and it gets acquired by a large cap. Sometimes I'll hold on to it, sometimes I don't. But if I chose it because of the small cap nature for the leverage, I want to sell that and then move to something else. That's just one example. It says stocks are a safe bet, but only if you stay invested long enough to ride out the corrections. When you sell in desperation, you always sell cheap. It says time in the market is greater than timing the market. So what I do on the website here, and I just gave a talk about it last question and answer session. I said, hey, look, we're picking up good setups. We're looking at companies that are inflecting from losing money to making money. And you have to have time in the market for it to work. We may get our timing off a little bit where you have to hold it for a little while. Some of the people, they bought some of the companies in the beginning, like say March, April timeframes of some really good setups, I thought. And then the company didn't go anywhere for a good 4 or 5 months. It was grinding sideways underneath a resistance level. And what they did is they said, oh, this isn't going anywhere. They sold out. That stock was at $5. And it ran afterwards all the way to $15. Now it's at another resistance line right now. But Peter Lynch would say, hold on to it and just keep riding it. That's what I'm doing. I own the stock. I've got a pretty good a pretty good profit on it. I'm going to let it ride. It's got a lot more room to run higher. Their projections look really good. And, another thing to think about, guys, is you've got this here. Companies only release earnings once a quarter. So in order for them to turn the company around, it may take a couple of quarters. It may take a year. And I mean, if you've got a really good entry point, you've got the charts, like let's say they're squeezing up and they're just moving sideways in that, I call it the dead period. And they're starting to go from a loss to come back up. because it's a commodity stock or something like that, or an energy service company, you got to give it time. You have to give it time. In order to become a good investor, you have to change your time frames. Things don't happen in weeks or months. They happen in years. If you change your time frame and you get your mind around it, you will win in the markets. You will win. But your timing has to be right. Your time frames have to be right. The way you look at the market, the way you look at your investments, they have to match what the market's going to return. Problem is, people, they get a 20% up move or 100% up move, they sell the stock, they get out of it, and they left a 10 bagger on the, they left a 10 bagger out there. You have to let it like actually go up and let it make you money. Sitting and waiting is the game in investing. It's not about taking action. When you're doing something, it usually is worse than not doing something. That's what I've found. So long that you pick good companies in the beginning and you're buying them in the right market conditions. Never invest in a company without understanding its finances. The biggest losses in stocks came from companies with poor balance sheets. Revenue is great, but cash is the lifeblood of a business. And this also pertains to a lot of people who look at these junior mining companies that have no cash coming in. They're going to dilute you at some point to raise cash or to raise capital. The ones that can get you in real trouble are the ones that have a lot of debt. They also, conversely, can be the ones that go up the most because they get sold off the most in a downturn, companies with debt, especially those that have debt and are high-cost producers. Those are also the ones that I highly go after if the market conditions change and it starts coming on up, the commodity, because you're going to get a whole bunch of leverage when that commodity price goes over the high-cost producers' break-even point, and they can pay off their debt, especially if it goes way above it. That's how I made my money with some of the companies in oil and gas at the bottom of 2020. I chose companies with some good debt. It was a risky spot to be buying in terms of risk, but I didn't think they were going to go bankrupt. And that's how you get the 20, 30 baggers, is because when prices go down and they have debt, they can go bankrupt. And a lot of people don't want to be in the stock because of that risk. And that's how I made a good chunk of my money in 2020 and 21 and 22. 10, it says, I don't know anyone who said on their deathbed, gee, I wish I'd spent more time at the office. Invest so that you can increase your free time in later life. Remember to enjoy the present while you build your future. 11, you can't see the future through a rearview mirror. The market is a forward-looking machine. Don't spend too long looking into the past. Spend more time discovering the winners of tomorrow. So look forward, don't look backwards. What I do here is I look backwards at the companies to see how the people are positioning in them. I look forward at the sector or the commodity. So I'm looking forward, looking at deficits. I'm looking backwards or real time of where we are in terms of ratios. And what I do is I align what the market participants are painting for a technical chart picture. I align it with the ratios and the values of that sector. And then I look forward at the deficits of what that commodity has. So I'm looking backwards, real time, and forwards all at the same time. That's what I'm doing. Number 12, it says, the typical big winner in the Lynch portfolio generally takes 3 to 10 years to play out. Exactly. I was just talking about that. You have to give it time to work. And when it works, you're like, oh God, that's huge. Investors need the patience to wait for the results that come from holding long term. They are not linear. They are exponential when they move. The problem is you have to be in them in order to get that exponential move. So nothing happens in the beginning for the most part. It's real boring when you buy something in the beginning because we're buying it in the dead period, and then boom, it takes off and you get hundreds of percent gains. That is how it works. Peter Lynch obviously knows that. He knows it inside and out, and that's why I like reading. It feels like, when you do a lot of work in the beginning, you find your companies, you find your sector, you got the ratio, everything's in alignment, you get in it, and then it doesn't do anything for like 3 months. people are like, well, what are you doing? Usually what I do is I keep buying. I buy. I just load up. And then when we get that big move, I'm that much happier for actually it holding down longer because I found the company that's good. I want to own it. And I bought a lot more because it stayed down. That's my mentality or viewpoint. I don't have to buy something, have it go up the next day or two or week or 3. I get in it, hold on to it, accumulate it, let it go. And sometimes it goes immediately. Sometimes it doesn't. Maybe it takes a little bit of time. But Peter Lynch is definitely, I think, one of the best investors. I like a lot of the things that he says. Everything that I've learned in the markets looking backwards and how I've adapted as an investor basically lines with Peter Lynch. Buffett, to some extent, I understand Buffett's approach. Basically, he would say, buy these boring companies, things that don't get engineered out of life. So, something like a food or a drink, insurance companies, whatever it is, that basically lasts hundreds of years, and you just buy it and never sell. That would also work very well. But I like these guys that kind of buy and hold. They look at things a little bit different. You don't look at it as I'm going to make money. You look at it as I'm going to make money, but I want to be a part of this. I want to be included. I want to have, if I could have part ownership of this company that's got a bunch of oil in the ground for the next 30 years, I want it. And that's what I've been buying. I've been buying a whole bunch of companies that are like that can increase production massively with good management teams that has a bunch of oil in the ground. Perfect. Because I think oil is going to be a problem the next 10 years. But that's me. Anyway, guys, lots of good information there. Definitely chew on it. Give me a thumb up for the content. Subscribe to the channel if you haven't already. And appreciate you guys listening. I know it's kind of a boring day with President's Day, but hopefully you guys get through it and we can get to Tuesday and get trading. All right, guys, we'll catch you later. This is Finding Value.